Today's Talk About It Tuesday question is, I want to start investing in the stock market, but I keep getting different advice from my friends. Some say I should invest in individual stocks. Some suggest mutual funds, and others say I should choose ETFs. What's the difference? Well, that is a great question because they all are entryways to invest in the stock market. So what are individual stocks? Individual stocks, also called shares, is actual ownership of a particular company. So a publicly traded company issues shares of ownership. So you're taking a share of ownership. What is the benefit of that? You actually own a piece of a company. The number of shares you own is the percentage of the company that you actually own. What's the cons of that? You are not well diversified. So you're going to put all your eggs in one basket and live or die with one company. That can be problematic because there are things that are outside of the control of that company that could impact the value of your stocks. Right now there are tariffs, and if tariffs impact that company, then the value goes down because people will sell it because it's not going to make as many profits. Economic shifts, we go through these economic cycles, and there's no company that does well in every economic cycle, so that could impact the value of your shares. The company changing management or just not doing well. There's so many things that could impact individual shares, and it takes a lot more specialized knowledge to create a portfolio, to create a diverse portfolio of individual stocks. So I would say if you are more experienced, very skilled, like to do research, like to stay on top of these things that are happening that could impact your company, then individual stocks would be good. Usually as an entry point for the novice, individual stocks are not a good way to start investing. And let me make sure you understand the difference. When I say investing, I'm not talking about trading. That is a whole nother ball game. Investing meaning for the long-term value, not to sell tomorrow to try to, get these highs and lows. For investing, individual stocks are generally not a good way for a novice to break into the stock market. So let's talk about mutual funds. There are different types of mutual funds. You have actively managed mutual funds, and you have passively managed mutual funds. So actively managed mutual funds are what most people are familiar with. You have a fund manager who puts together a diverse portfolio of stocks, bonds, or other assets, and you buy ownership of shares into the fund itself. So advantages, you have somebody whose goal is to try to beat the market, right? To try to beat the S&P 500. Their goal is to make this fund profitable. Cons that come with that, and pros also, you're pretty well diversified if you have a mutual fund. Cons, fees tend to be higher because it's actively managed. Taxes that you pay on it tend to be somewhat higher because that person is trading inside of that to try to maintain a profitable portfolio. That's kind of the con. So higher fees, less return in general, not terrible. Then you have passive funds like an index fund that's based on an index. Could be based on the total market. It could be based on the S&P 500. Could be based on large cap companies, right? So you have these passively managed funds that only follow these indices, and they tend to be more profitable because the fees tend to be lower. There's less movement in there, so there's less taxes that are being paid on it. And it is the market. So if you had one based on the S&P 500, it's always going to be what the market, the highest part of the market is at that time. So for the novice, index funds are the way to go. Even for an experienced person, you should definitely have an index fund. But actively managed mutual funds, a little more risky, like I say, only because you lose some profit. Passive index funds, passive mutual funds like index funds, are much more safe and they're well diversified also. And what is an ETF? So an ETF is like a mutual fund that trades like a stock. So ETF, exchange traded fund, is kind of a hybrid of a mutual fund and a stock, meaning when you buy mutual funds or index funds, you cannot trade them every hour on the hour or any time of the day like you can an individual stock. You will get whatever the price is at the end of the day, right? So if you were concerned about getting the best price at the best time, then an ETF would be better than a mutual fund. Most mutual funds are diversified somewhat, but tend to be based on a sector. So let's say you say in this cycle, energy is doing well. You would find an energy ETF and it would have maybe 10, 15, 20 energy companies, right? So instead of you trying to profit off of one energy company, you profit off of 10, 15, 20 energy companies that are in the ETF. Usually, like I said, very sector-based as opposed to broadly diversified. Has a different tax than stocks because ETFs, because you can trade every hour on the hour, it has actually its own tax requirements, which are pretty loose. They're not as stringent. So you pay a little less taxes than you would if you traded individual stocks. I think the cons to that are because they're really based on a sector. Instead of like an individual stock, you live and die with one company. In an ETF, you live and die with one sector. So if you wanted to take advantage of a sector for a period of time and you say, well, I don't have a lot of money, so I can't just buy one consumer cycle, stock, I'll get 10, you get it in an ETF. And that's actively managed also. So someone's actively trying to keep that ETF in a place where it beats the market in general. So that's the difference. You see that some of the differences are subtle. Some of them are not so subtle. Some are less risky, some are a little more risky, but sometimes with the higher risk, there's a potential for greater return. But if you're in it for the long haul, I think you don't want to play these big risks. I think if you're a novice, you don't necessarily want to invest in individual stocks without having built up a knowledge base on a company, a sector, how the market works, how the economy works. Like there are a lot of things that can impact an individual stock. So that's the difference. But you definitely need to get in. Everybody should be investing in some capacity in the stock market, but choose what makes the most sense for you. But I'd love to hear what your strategies are, what you think about the differences are if you've invested in each of these types of vehicles. But please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.